So the Federal Reserve met for the first time in 2026, and even though the results aren't what we wanted, I'm still want to give you some updates. For one, Trump has ordered $200 billion with a B. You're talking about printing money. Let's go here. $200 billion to be purchased in mortgage-backed securities. I'm going to explain how that can help lower the rate and how it's already adjusted the rate a little bit for mortgages. I'm also going to share with you his executive order that he signed and a few other tax advantages and things that you need to be aware of as we roll into 2026 so you can save money when it comes to buying a home. You see, mortgage-backed securities are basically bundled and bought. So you have Fannie Mae, the Federal National Mortgage Association. They actually buy loans from lenders. So what they've done is they say you no longer have to have a credit score. Not sure if you heard that or not. You don't have to have a credit score. Now, that doesn't mean that the lender's not going to check your credit. They're going to check your credit score. And each individual lender is going to give you a loan based on that credit score. Some lenders may say, you know, VA loan, you need a 600. Some lenders say, no, you got to have a 580. It's really up to the lender. But here's the way it works. Lenders, mortgage lenders, are going to look at what they can loan based on that credit. They no longer have to go by the rules and regulations of Fannie Mae because Fannie Mae says we don't need a credit report anymore. Another thing that's happening, that didn't make any kind of sense, but go with me here. The other thing that's being done is $200 billion being purchased in mortgage-backed securities. So what that means is it frees up money that lenders have to loan money. And when it frees up money that lenders have to loan money, $200 billion scattered across the country of all these lenders, then it frees up money that they have to loan you money. As a result, we see a trickle down in mortgage rates. And when we see the rates drop, we see people come out of the woodwork. But you also have to understand that the median first-time home buyer right now, and it's always been first-time home buyers, have been the one that's pushed the market. It's typically 35 to 40% of all the homes purchased in the United States on any given year have been first-time home buyers. Well, 2024, 2025 has been really low, around the 20 to 22% mark of first-time home buyers, which is the lowest it's been in 30 years. And now, the median age for our first-time home buyers, 40 years old. Median means some are a little higher, some a little lower. It's not really an average. I think the average is probably about 34 to 35. To make a long story short, it's this. Trump wants to make it so you can use your 401k, not your IRA or not a SEP, a self-employed pension plan, and I'll talk about that here in just a second for you self-employed people like myself. I've been self-employed for 30 years. But if you have a 401k, in other words, you're putting money from your check that's pre-tax dollars. In other words, it's not taxed, it's going into stocks or whatever it may be within your 401k. If you were to pull money out of that or borrow money against that, you have to pay taxes, you have to pay penalties. If you borrow money against it, you have to pay it back with interest. So what Trump's trying to do, he's basically saying, hey, if you've got $20, $30, $40,000, even $10, $12, $15,000 in your 401k, you can use that as a down payment on your home without having to pay that 10% penalty and without having to pay taxes. Now what that means for you as a buyer is it frees up you an opportunity to take that money and purchase a house. Now here's what's really important. If you get an FHA loan, it's going to cost you 3.5% down. And they just raised the FHA loan limit to be just over about $520,000. Now it's higher in some places like San Francisco, California. It's up in the $800,000–900,000 mark. The point I'm trying to make is you don't need a whole lot of cash. Even if you have money in your 401k, you don't need a whole lot of cash. You need 3.5%. So basically, if you bought a house at, say, a $300,000, $400,000 home, you're only looking at $12,000, $13,000 max because the seller can pay all your closing costs. Now, those closing costs will run around 3.5% of your loan amount. So at the end of the day, the seller can pay your closing costs. It don't cost you a whole lot of money. And if this passes, you can actually pull that money out because a lot of people don't have a whole lot of savings, but they got a little money in retirement. But by being able to pull that money out of retirement, you put it in a home, an asset. And I know a lot of you may argue with me, and feel free to go ahead and do that. But a lot of people say this is a liability. I'm going to tell you, those of you that have bought real estate, own real estate, invested in real estate, flipped real estate, you've been in real estate like me for 30 years, that right there is an asset that I own and that I can sell. Now personally, I'll give you my opinion and you're welcome to disagree or just chime in anytime if you're a mortgage banker, loan officer in the business or whatever it may be. If you agree with me, feel free to give me a thumbs up or just leave your comment because it's good information. That's how we all learn. And that is, I don't think the rates are going to go much below 5.75% even if we see the rates drop. I personally think Trump's going to put somebody in to run the Federal Reserve that's going to drop the rates, and we're going to see a rate drop. However, I don't think we're even going to see 5.5%. I'd be real shocked. I think we may see 5.75, 5.85. And the reason being is that it has to keep a healthy housing market. If they drop the rates too low, you're going to have a feeding frenzy. And when you have a lot of demand and the supply is low, you're going to have home prices go up. And when home prices go up, it's just a never-ending battle. We see that already right now. You'll probably agree in your market, you think home prices are a little high. And rates actually are pretty cool, because you got to consider this. For 13 years, mortgage rates never went over 5.25%. And so being that they never went over 5.25% for 13 years, if you were 15 years old when rates literally started dropping that low, and now you're in the market to buy a house at 28 years old, when you're seeing 6%, you're thinking the rates are high. 6.25%, the rates are high. I remember when they dropped the rates to 6% back in the 90s, and it was a feeding frenzy. Everybody was excited. So at the end of the day, you just have to look at what's good for you when it comes to buying a house. And most importantly, what you're comfortable paying. Now, I mentioned a SEP, which is self-employed pension plan. Now, even if you don't have that and you're self-employed, here's a new loan program. It's kind of been out for a while. They've tossed it around a little bit, but I just discovered that they're rolling it back out. So this is really cool. Grab a pen and a piece of paper, you want to write this down. Those are people that are self-employed. You write a lot of stuff off, and since you write a lot of things off, at the end of the year, your income looks small, but you know that you could afford a nice home. And let's just say you're renting right now. You don't own a home, but you own a business that drew $1 million in deposits. I mean, like literally, if you're a contractor and you did work, you lay brick, electrician, plumber, you own a restaurant. There's so many small businesses in the United States. I mean, millions of small businesses in the United States. We write a lot of stuff off as self-employed. So here's the loan. They take what your gross deposits into your account. So for example, if you take your gross deposits and you made $1 million in deposits, they're going to take and divide that by 2. And when they divide that by 2, you're going to be left with $500,000. They're going to take that $500,000 and they're going to divide that by 60. And that is your monthly income. They're not going to look at W-2s. They're not going to look at tax returns. They're not going to look at expense reports. They're not going to look at anything. They are going to look at your credit. You got to have a 660 or higher credit score, and they are going to look and make sure you have a little cash to put down. These types of loans, you're going to need 20% down, a 660 or higher credit score, but they're not going to look at anything other than that pretty much to make sure that you actually have deposits as a self-employed business owner. Now, not to jump around, but before I forget, let's jump over to Jerome Powell. See, Jerome Powell is the chairman of the Federal Reserve, and the Federal Reserve, unfortunately, doesn't have anything to do with the United States government or the federal government, even though it's got federal in it. I know that sounds kind of crazy. However, the President of the United States appoints the chairman of the Federal Reserve. Now, once they're appointed, they're pretty much locked in, right? However, Jerome Powell, who's there right now, his term is up in May, and in May he's going to be out, and the president is going to appoint another person. Now, here's a big question for you. Do you think that we're going to see rates drop once he appoints a new person? Just give me a yes or no. I mean, personally, I think what Trump's doing, and he literally, I just seen it on the news this morning, he said rates should be lower. The Federal Reserve met, rates should be lower. They're meeting, it should be lower. And so when Jerome Powell's not there, I have a strong feeling that someone else is going to be appointed, that he's going to announce any day now, and that person is probably going to lower the rates. Now, this is what you have to understand. If they lower the rates from, say, 6% to 5.75%, that's 1/4 of a percentage point. Now, if you were to purchase a $300,000 house, the difference in that between 5.75% and 6% is $48 a month. Now think about that, because so many people get caught up in, oh, the rates are 5.75, I can get a good rate. Don't get me wrong, you're saving money. You're saving $48 a month between a 6% rate and a 5.75% rate on a $300,000 house, which is $1.60 a day if you want to get real ridiculous, right? And my whole point is, if you want to buy the house and you can't get approved, don't let 1/4 of a point get in your way, because here's what's going to happen. I have a strong feeling that come June, July, we are going to see interest rates at that 5.75%. And when we do that, we will see more homes come on the market. Not only will we see more homes come on the market, more importantly, we're going to see a whole lot of buyers getting back into the market. We're already seeing an uptick of that, of 31% in mortgage application increase, literally just in the last 3 months between November, December, and January. Now, as the rates drop, you're also going to see more people putting their homes on the market. And the reason why we don't see a whole lot of homes on the market right now, if you watched any of my videos, if so, give me a thumbs up, subscribe to the channel if you haven't already. I always forget to introduce myself. My name's Wayne Turner. I've been in the real estate business for 30 years. I've bought, flipped, sold, brokered, owned real estate brokerage companies, and I've helped literally thousands of people buy their homes and sell their houses. And I only share that with you so you can have the confidence knowing that what you learn from me is actual real life experience. I didn't read this in a book or make it up. It's just literally years of experience. We have to understand this: 67% of the people that have a mortgage right now have less than a 5.25% rate. That means people are sitting pretty good. There's more equity in houses right now than ever before in the history of the country. The average person is literally staying in their home 12 years. When I first got into the real estate business, everybody was moving 4 to 5 years. And now that is more than doubled. As a result, people have equity. People also have debt. Unfortunately, credit card debt's the highest it's ever been. People also have expensive cars. A new car right now is just over $50,000 for the average new car. But here's what people are realizing that they can do. Maybe you know, maybe you don't, but here's something that's really important. You can take the equity of your home, pay off some debt. You may have a higher rate, for example. Let's just say you got a 4.5% rate, but now you want to go and purchase another house. I tell everybody, especially if it's your second home, if you learn anything from me, try to put your home on a 15-year note, especially if it's your second home. So here's what happens when you put on a 15-year note, and it's your second home. You're typically probably a little bit older, maybe in your late 30s, 40s, 50s. You put that on a 15-year note, you're going to pay a lot less money in interest. You're going to save a whole lot of money. Most importantly, you're going to pay it off faster. But here's what also happens. Not only do you pay it off faster, but you can take the equity out of that house. You can pay off any and all debt. Now, you may have a higher rate. Let's just say you got a 4.25% rate now, or 4% rate now. And if you can get a 5.5% rate, yeah, you're going to pay more, right? However, you have to weigh out your odds. Let's just say you want a house with a little bit more space. You want a house with a pool, house in a different school district. Whatever the situation and reason may be, you have to weigh out those odds. And by no means am I trying to talk anybody into buying or selling their home. I'm just giving you the best informed information that I know that can help you make the best informed decision. So at the end of the day, you can take your equity out of your home. You can actually pay off debt, and you can still purchase another house. So for example, if you had $100,000 in equity when you sell your house and you got $50,000 in debt, you can sell your house, move into another home, pay off all your debt. And then where you've got 3 credit cards, maybe a student loan, hospital bill, car note, whatever it may be, now you only got 1 note, and that's your mortgage payment, and you're debt free. And that is a pretty free feeling. Now, rest assured, that's going to be pretty motivating for a lot of people, and in doing so, you'll have more homes come on the market. But I find this a little puzzling. It got me kind of perplexed, if you will. They say that we're in a housing shortage, but yet, for example, in New Orleans, Louisiana, there's a 6-month supply of homes. And let me explain something to you. It's called the absorption rate. So when you have a supply of homes that's 6 months, you're teetering really on a buyer's market. Typically, once you go over that 6-month mark, it's a buyer's market. That means more homes are on the market for sale than there are buyers buying, and it makes it advantageous for the buyers to buy in that market because sellers get a little bit more motivated to sell. And if you're out there looking at houses, I'll give you a couple of quick tips. Homes that have been on the market 100 plus days, it's not that most of the time that something's wrong with them. You have to look at the price. A lot of people start a little high and they keep coming down in price. Ask your real estate agent. If you don't have one, you can reach out to contactwayne.com. We can get you with a lender. We can get you with a real estate agent. There's no cost and no obligation that you have to pay me for doing that. You can just shoot us your information. But it's important to know that that absorption rate shows you how fast buyers are actually buying houses, and it gives you a good indication. Now, I tell everyone, real estate is hyper-local, and your market really depends on your market and how fast homes are being purchased. You got houses right now where you may be in cities in Florida where every 10th house is on the market for sale, and the reason for that is Typically, when you see a market like Florida, there's a lot of Airbnbs, there's a lot of second homes, a lot of vacation homes, and usually it's one of the first things that sell. It's almost kind of like when you buy a motor home or a boat or a motorcycle, you kind of get it and get it out of your system. Well, there's people out there that buy houses and be like, I want to get in the rental business, and they decide they don't. Or I want to buy a home so we can go vacation, and the kids don't ever vacation, they decide to sell the house. And then there's situations where people buy a second home and it just doesn't work out for them, and financially, they got to get rid of it. Now, if you're on the fence about buying or thinking about buying, it's also important to know what the credit scores are, because I did tell you that Fannie Mae says you don't have credit scores, don't have to have credit scores, but lenders are requiring credit scores. They're still going to pull and look at your credit score. But listen, most lenders will pull a soft pull on your credit. They're not going to pull a full hard pull. They're going to pull a soft pull. That means they just kind of pull your credit, look at your scores, don't go into great detail. It's also important to know, if you're a veteran out there, you can get a VA loan. You only need a 580 credit score. You can get a USDA loan. You only need 620. You can get an FHA loan, you only need a 600. So these credit scores, the minimum requirement has dropped. Now, they're still going to look at everything from your debt to income ratio and all of that. Every loan is different, and what I mean by every loan is there's conventional FHA, USDA, you get all that, but each individual person is different for that loan. So listen, thank you for watching. Give me a thumbs up, comment, ask questions, be sure and share this video. Most importantly, subscribe. It doesn't cost you anything. We're not going to come knocking at your door. We're not going to send you an email or anything like that. When you subscribe to this channel, it just gives you more real estate information if you want to see it, you want to learn, and it also shares it with more people like yourself who have an interest in real estate. Until next time, thank you and God bless.